Hello, welcome back, guys. So, taking a look at our market trends module, you can kind of see which stocks are actually trending right now, and this is updated live pretty much every hour. As you'll see right now, stocks like Shopify, Tesla, Snowflake, CRM, for example, at Salesforce, are trending, and that's because of price action. One of the stocks that I wanted to talk about, and I'm going to be making videos for pretty much all of these, or if not most of these, is Snowflake. So I will be taking a little bit of a closer look at Snowflake, which reported earnings. As you'll see, I can just click here in our tool and pretty much get the financials of the company. Remember that you can gain access to our tool by becoming a Patreon. The link is always in the description box below any video that I create. So if you're interested, take a look at that. But over here, you will see that Snowflake is actually down 14% in the after hours market. This means that something happened. And if you take a look at our stock news module here, you will see what happened. Why Snowflake stock is falling after hours. Snowflake offers weak product revenue guidance, so stock tumbles and things of that sort. Tumble on light guidance revenue. Guidance pretty much. So let's take a look at the finer details here. So the shares tumble on light product revenue guidance, as you'll see over here. So let's see exactly what the numbers were. 11 cents that's adjusted versus 4 cents expected by analysts, and a revenue of 557 million versus 539 million. And always take the adjusted thing with a grain of salt. I will be making a video about this. One of our subscribers actually asked to make a separate video about this adjusted thing, and I will, because I think it's super important, because Snowflake is basically, for the most part, losing money here, and you will see exactly what is happening. Now, the company's revenue was up 67%. This is a high growth company in terms of its revenue, but growth was lower than the relevant growth in the last quarter, the corresponding one. And the largest part of revenue, product revenue, also grew 67%. And as you'll see here, the thing that pretty much seems to have done it for Snowflake, pretty much a decline, is the fact that they anticipate product revenue will be between 535 million and 540, short of the 553 that was expected by analysts. So it's a little bit shorter than expected over here, and this caused this massive decline, or at least one of the reasons, of course, because the company is also not a company that's making money, frankly, and so this also has to play a big significant role, really. Don't be confused by the adjusted. You will see exactly what is going on a little bit later in this video. And so product gross profit margins, operating income margins, and free cash flow are expected to be 75%, 3%, and 21% for the year. And they do have 72,100 customers over here, about 7,300. Okay, interesting, but let's take a little bit of a look at the actual financials again. We can visit our metrics page over here in our tool. And you will see here that the P ratio of the company is negative. So you will be asking, how is the company generating a positive EPS? That's because it's adjusted. And adjusted EPS basically means that they exclude some of the costs that the company incurs. And so it's sort of like an EBITDA, sort of like a cooked version of the earnings, which a lot of companies using, the ones that are mainly losing money for the most part. Now, again, I'm going to be explaining exactly how that works in a separate video, so stay tuned. I'm probably going to be doing this in the next few hours. The price to free cash flow is positive because of the adjustments. We will see that a little bit later. And take a look at these outstanding shares over here. The outstanding shares count increasing tremendously because when the company doesn't make money, they have to finance themselves somehow. And there's two ways to finance yourselves. You either get loans, so you have extra debt, or you issue more shares and you pretty much sell it to shareholders, people that are willing to buy it. But we as, savvy investors, hopefully, we don't want to be buying anything at any price. We want to examine whether the company is worth our money. And this is exactly what we are doing in my videos over here. You will see that the company also has quite significant liabilities compared to the free cash flow that they generate, even though their debt is very low. But still, this means that they don't make enough free cash flow for the most part, as we will examine again a little bit later. The revenue growth of the company is tremendous because, again, this is a high growth company. This is what investors pretty much are banking on. But you have to be super careful with revenue growth because the company has to be positive in terms of how much money they are generating. If they go into negative territory and it becomes more and more negative. So what's there for an investor? It's tricky and it can be a big issue over here. And the free cash flow is increasing. Again, this has to do with the adjustments. So we will examine that. Now, a lot of these ratios are negative because the company is losing money. Again, don't be confused by the adjusted one. And if we take a look at the financial statements, you'll see the exact picture over here. Now you will see that the company is generating much higher revenue, which is a nice thing to see. Yet their net income is much more into negative territory, so it's red and getting more and more red. So that's something that you hate to see over here. And as you see, the actual EPS, it's much lower. It's not the sense that you saw earlier. It's negative, of course, because the company is losing money. And as usual, you can always examine what they said in their pretty much report by taking a look at our module again. We have all these things here. This is in company analysis, actually, where you can go and find the actual earnings transcripts and pretty much read through that, because in most of these transcripts, they talk about EBITDA, for example, or adjusted EPS and what kind of items they exclude. Again, this is going to be a separate video. I don't want to go into much detail in this one, but you can, of course, find all the, pretty much the details for most companies in their transcripts if you do care to see what kind of items they exclude in order to create their adjusted EPS. Very, very important. In terms of their balance sheet, you will see that the company over here is having a total equity of $5 billion. Pretty much a big part of it is additional paid-in capital, because the company has been issuing tons of shares, is what we saw. More than 100% of its original float has been issued in extra shares. A bad thing to see here. You don't want to see that as a shareholder. They are diluting you tremendously. Not a great sight. And in terms of the cash flow statement, what you will see here is that it is negative, and it becomes operating cash flow that is positive after the stock-based compensation is excluded. A typical thing that you see in many tech companies. The fact that the stock-based pretty much expenses are added back to the free cash flow, because it's a non-cash expense. It's added back to the operating cash flow, I should say. And then is also, you can also see a positive free cash flow here, which again, compared to the negative profit, the fact that the company is losing money, is not a great sight. It's only because of the adjustments that you see a positive value here. And the thing is, and what we do want to see here, is what the company's evaluation would be in terms of its stock. Of course, this company is not paying dividends, so it doesn't make sense to be using our dividend discount model. But we can use our stock evaluator module, pretty much the default one, which is the discounted cash flow model, which works for most companies, if not, I should say, the vast majority of companies. Maybe excluding some companies like banks, for example, where things are more convoluted there. But what could we do here? In terms of the revenue growth of the company, it's tremendous. The company has been growing at a tremendous rate. So we can still use some high values here. So 20, 30, and 40%. These are super high. So I don't anticipate that you will have like 40%. This would be amazing. But it could happen. The thing is, in conjunction with a high net income margin, which has been negative for the most part in the company, not for the most part, for the whole part, pretty much, this is very unlikely to happen. So we still have to use some sort of profitability, some sort of potential positivity here, because if the company never makes money, then it's not worth anything. So we need to see what happens when the company is actually worth something, when they are generating at least some profit. And again, this is nowhere near happening right now. It doesn't look like it. The net income margins are deeply in the red. But we do want to see what kind of price we're getting when the company becomes slightly profitable. And so in terms of the free cash flow margin, again, we cannot use these values because they are negative pretty much. They are not coming from actual profit. And so we will use sort of like something that is a standard thing, 80, 90, and 100%, about the same. 100% meaning about the same free cash flow margin as the net income margin. Not about the same, exactly the same. That would be 5% actually. And this would be 90% of the 3%. This is how it works. And in terms of the annual return, 13%, a typical ask for our companies here, for our return in our stocks. And let's hit calculate. And you will see that the prices we're getting here are much lower than the current price. And again, the current price is going to be lower because the stock is going down about 14% is what is currently down at. And so we're probably getting at about $110, $15. We'll see where it's going to end up tomorrow. But the thing is that even if the company becomes profitable, it's still super expensive. And remember, these kinds of values are nowhere near to be found right now. They are, super confident over here. So, and super aggressive. So this is definitely not a buy. You cannot be entering this one. It's a very risky company to be owning right now. And I'd definitely avoid it. Now, again, in the upcoming years, maybe the company does very well. But the point is that it is expensive for what it is right now. And when you are buying it today, these kinds of financials are just too expensive to be buying for today's stock price. But do tell me what you think about Snowflake, whether you own it, whether you think of adding it potentially. And remember to like this video, that helps a ton, and subscribe, of course, if you're new around here. There's a lot of companies that are having some interesting news right now. As I checked, as I showed you earlier, in the market trends module, there are companies that are getting a lot of stock tweets impressions. This is updated by the hour, so when we're entering a new hour, you're gonna be seeing completely different things as stock tweets impressions pile up. So this is very nice, and you can see a lot of companies getting added here. Apple is again one of these. AMD is becoming one right now. AIPRN was earlier too. So you will see companies that are getting the pretty much some of the hype hourly, pretty much. ARKK is another interesting one. Okay, so thank you for watching, and I'll see you in the next one. Bye bye.